a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Well, whether you're bullish or bearish oil with what's going on with oil prices lately, there may still be an oil ETF for you to consider. At least that's what our ETF research director, Nina Mishra, says, and she's with me here now to explain further. So, overall trend for these oil prices still continues lower, but you say there are a couple of bright spots.
Well, yes, as you mentioned, overall trend is still lower. And yesterday also, oil dipped below $30 a barrel on, continued worries over the supply glut and declining global demand.
And yesterday was the 2nd of February, just so everybody knows.
Yes,
Yep.
and it seems that it is very unlikely that these major oil producers like Saudi Arabia and Iran will be able to arrive at any agreement to cut production. Last week there were some rumors originating in Russia, which were very quickly denied by Saudi Arabia. So I think production is going to continue high and go higher, and demand will continue to decline this year because weak global economy. And Iran's re-entry into this already oversupplied market further complicates the situation. So it seems that oil may continue to slide. It may stay lower for longer, and many traders and investors have been shorting oil this year, and they have profited a lot from that trade. But at the same time, there are some investors who believe that oil may actually be the trade of the year because it's so low now, and if you are a longer term investor, then probably you are going to reap rich benefits if you invest in oil now and oil rebounds from these levels in maybe a month, 2 months, or whatever. So we are going to discuss both ETFs that are suitable for bearish investors and for bullish investors.
And so where do you believe oil is going to go?
I personally believe that it is going to stay lower for longer. So this may not be the right time to start buying. Maybe you should see some signs of stabilization and then start investing in oil. But timing the market, especially the oil market now, is very difficult. So if you are an investor with a lot of risk tolerance and very long-term investing outlook, then maybe you can start looking at these bullish ETFs as well.
Okay, so you have 3 different scenarios here. The first is the inverse oil ETF.
Yes, that is if you are bearish on oil, then you can use these ETFs or ETNs to short oil. So the first one is by Velocity shares. It provides 3 times inverse exposure to crude oil futures, slightly expensive at 1.35% expense ratio, but it's pretty popular in the space. Trading volumes are quite high, so trading costs are low, and that is good for traders. Traders should consider trading costs as well in addition to the expense ratio.
Okay.
And it has returned more than 68% this year.
Wow.
Then the second one and the third one, DTO and SZO, they are both issued by Deutsche Bank. And the first one provides 2 times inverse exposure to oil futures. It is slightly cheaper than the first one, but trading volumes are also slightly lower. The last one provides 1x inverse exposure, same expense ratio, but underlying assets under management are very low, just 22 million. So and trading volumes are also pretty low. So investors should consider those facts also if they decide to invest in buy these ETNs. Now all these 3 are exchange traded notes, so they carry the credit risk of the issuer. Additionally, all these inverse and leverage ETFs, investors should always remember that they are designed to match their stated objective only on a daily basis. So if these ETNs are held for longer than a day and particularly if the market is very volatile, then their actual performance may vary greatly from their stated objectives. So investors should be aware of risks associated with these inverse ETNs, and they should monitor their positions on a daily basis and rebalance if required, if they decide to buy these ETNs.
All right, then we have energy equity ETFs.
Yes, for investors who are expecting a rebound in oil prices, there are two ways to invest. You can invest in these companies, energy companies, via ETFs, get a diversified exposure to well-known energy companies like Exxon and Chevron and others using energy equity ETFs. And you know that these companies are fine, solid, cash-rich companies, which are just going through bad times. So over longer terms, if you maybe 2 years or 3 years or 5 years from now, I believe that Exxon and Chevron will not be trading at these price levels. They would definitely be higher. Okay. So there are three options. The first one, the most popular one, is the Spider Energy ETF, very low expense ratio, just 15 basis points. It is down more than 8% this year. The other two are also down more than 8%. Second one is issued by Vanguard. It is the cheapest ETF in the space with just 10 basis points in expense ratio. And the third one is issued by iShares. It is slightly more expensive compared to the other one with 43 basis points expense ratio.
All right, and then finally, oil commodity ETFs, and these more track the price of the commodity, the futures price.
Exactly, right? Exactly. So these are more suitable for shorter term investors. The longer term investors should probably consider oil energy equity ETFs, because these try to, as you mentioned, they track the price of oil using futures. So their performance matches their objectives over shorter term, but if they are held for longer term, then their performance can be much worse than expected due to issues with futures like contango.
So do they just track the futures prices in the front months or in the farther out months as well?
Not so much in the further out months, because when you roll over, then you face those kind of contango issues. Right. So there are three popular ETF and ETNs in the space. The first one is US Oil Fund. The ticker is USO, and this is an ETF. It's down more than 22% this year, but pretty popular with more than $3 billion in assets under management. This is also the cheapest. It charges 45 basis points in expenses. The other two, oil and which is issued by Barclays, and DBO, which is issued by Deutsche Bank, both charge 75 basis points in expenses, and they are both structured as exchange-traded notes. There are, again, a horrible performance this year. And as I mentioned earlier, that ETNs carry the credit risk of issuer. Yes. Additionally, this particular ETN, oil, has faced a lot of tracking error issues also of late, because it has been trading above its underlying value. In fact, Barclays warned recently, they warned investors that investors should be careful about buying this ETN if it is trading at a premium over its underlying value, because then investors can lose, they can incur losses when they sell later. Sure. And at that time it is closer to its indicative value. And even if oil prices have gone up, investors may still lose because of this tracking error. So investors should be careful that they buy these ETNs only when they are trading very close to their underlying value.
Okay, full disclosure, do you own any of these that you talked about?
No, I do not.
All right, if you want to find out more about this topic or other ETF topics, all you have to do is go to our website, Zacks.com, and using the top toolbar, The Funds tab will cause a drop-down window to appear, and it'll take you right to the ETF section of our website. Meantime, with Nina, I'm Terry Ruffalo.